Crocs announced first quarter results before the market opened on Tuesday, and I gotta say that these were phenomenal results from Crocs. They surprised me when I opened up the report. And shares are up a little bit today. They were up pretty solidly early in trading, but now only up about 5%. So it's interesting to see the market's reaction. I think there's really one number that the market is focusing on, and that's the growth number for Hey Dude in 2024. But I'll get to all those numbers because I think the real story for Crocs is that the core brand is just doing phenomenally well. There's a ton of cash flow coming from the business. And this is set up to be a really, really solid year that isn't to overshadow the fact that Hey Dude is really not doing very well and is probably a bad acquisition that the company made. But we'll go through all that today. I want to dig into the results and the market's reaction. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's get to the stock reaction before I cover the results in total. This is the stock movement today. You can see that the previous close was $126.63. Shares were trading over $142 early in the day today, but that's obviously dropped back down. So as the market has processed more of the earnings report, obviously a little bit more disappointing. I'll get to those numbers, but I want to start with the earnings presentation. I'm going to bounce around between the press release and then actually guidance for the fourth quarter. So that came out a couple months ago, because guidance is really what they blew out of the water. This is the high level numbers from the first quarter. Crocs brand revenue was up 16%. That's overall revenue just for the Crocs brand. And you can see that the strength was really across the board, but international revenue was up 24%. North America also up 9%. So really, really strong results. Hey Dude revenue was down 17%. Both of those were actually better than expectations. This is a look at the financial outlook as of the fourth quarter earnings report. And this is the first quarter outlook. What they expected was Crocs brand revenue to be up 6 to 8% and Hey Dude to be down 20 to 23%. So you can see 6 to 8 really crushed that with 16% growth. There seems to be no end in demand for the Crocs brand and the Crocs style, which as somebody who doesn't actually wear Crocs shoes, I think is still kind of crazy, but my kids love them. So who am I to argue with that? They have the number 7 brand in Piper Sandler's survey that asked teens what the top brands were. So that I think that's really interesting. Double-digit growth in Western European markets and triple-digit growth in some areas of China and Australia. That's always been an area of potential for Crocs, is growing particularly in China. And so we've seen some green shoots there, but that's obviously really taking hold now. The Hey Dude brand, better than expected, but not great guidance for the full year 2024. I'll get to that in just a second. But what we see overall when you combine the entire company together is revenue up 7% to $939 million, adjusted gross margin 56%, and operating income of $255 million. So just a phenomenal operating income margin of over 25%, of over 27%, and earnings per share of $3.02. The adjusted gross margins are obviously much better at Crocs and continuing to rise. So I think that's really notable. And then the Hey Dude brand still struggling. So I don't know if there's going to be a real turnaround for that brand anytime soon. But the couple of things that management has done a really, really nice job of as you're growing the business like this, one of the things that can get out of control is inventory. There's been an 18% decrease in inventory over the past year. And then their allocation priorities are to obviously grow the brand, pay down debt, $1.7 billion in borrowing, and that's within their range. What they do is they say, how much debt do you want to have to adjusted EBITDA? And this is in the range of what they want to have is 1 to 1.5 times. I'll get to the reason that they didn't pay down debt during the quarter in just a second, but they do want to also return shareholder cash with another $875 million remaining on the authorization. Given the current market cap of about $8 billion, that could be potentially about 10% of the company. Here's where things got a little bit disappointing for Crocs. And I'm going to compare this to what they guided for last quarter, because they did give fiscal year 2024 guidance. So what they're saying is they expect 7 to 9% growth for the Crocs brand and -8 to -10% growth for Hey Dude. 7 to 9 is much better than the growth that they previously expected for Crocs of 4 to 6%. So that's great. What is not good is the expected decline in Hey Dude brand sales when they were previously expecting full year flat to slightly up sales. So if you want to see why the market is reacting negatively, yes, you have a positive here for the Crocs brand, but then that's offset by a negative here for the Hey Dude brand. So that turnaround is obviously not going as management had hoped, but they do expect earnings per share to now be $12.25 to $12.73 per share. That is up from a previous range of $12.05 to $12.50 per share. Let's go over here to the statement of cash flows, because this explains why there's not a bunch of cash that's coming out from the business right now and why they're not paying down debt or buying back stock, at least in the first quarter. And the big number to look at is accounts receivable. What happens in retail is you ship a product to a retailer and then they're going to pay you 30, 60, 90 days in the future. So you book that as a sale, but you don't actually get the cash until sometime in the future. So what happens with the holidays is oftentimes you're shipping that product in the third quarter, late in the third quarter, early in the fourth quarter, and those are your best quarters for sales. But if you're not growing quite as much, then you're going to be collecting cash late in the fourth quarter, early in the first quarter. What we've seen with Crocs is they're actually still growing, so their accounts receivable is growing in the first quarter. And that's the reason that you don't have a big increase in cash. And this is actually one of the downsides of a growing company in product goods. It's just the way that the economics work. When you get paid in the future, if you're growing, you actually have to have capital to grow the business. So great that there's growth, but doesn't necessarily mean that there's a ton of cash coming out of the business, at least not quite yet. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, I think overall you look at Crocs results and they're really phenomenal. The company is just performing very well when it comes to the Crocs brand specifically. The turnaround for Hey Dude is obviously taking a little bit longer. They recently announced a management change there, so we'll see if that can kind of take hold. But if the core Crocs brand, which is about 3/4 of the business, continues to do really well, that's ultimately what's going to drive the business going forward. And I would look at Hey Dude as essentially icing on the cake. If it does turn around in 2025, great. That could be a potential growth vector, maybe a potential driver of additional free cash flow. But right now, the core business is doing extremely well, and that's what I'm focused on as an investor. It makes the debt that's on the balance sheet look a little bit less worrisome. It gives the management the opportunity to potentially buy back stock, which I would love to see them do, given that shares are trading for right around 10 times earnings, and the business continues to grow. So if you're buying back stock at a reasonable price to earnings multiple and you're able to grow the business, that's really accretive to long-term shareholders. So love what I'm seeing for Crocs right now. I still think this is a phenomenal value stock with a lot more growth potential than a lot of investors are pricing in, especially when you look at those international markets. That's just phenomenal growth in international markets for the Croc brand. And it doesn't seem like the core Crocs business is really slowing down. And when you're popular with teens, that's probably the best indicator of what your business is looking like going forward. But what do you think about results from Crocs? I'll leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.